After going through this module, you will be able to learn about the cash credit systems, its features and its drawbacks, about credit limit, security and interest charged on cash credit account, about drawing power and its calculation, about the difference between cash credit and overdraft, about the historical perspective of regulations of bank finance. Banks finance has always been the most preferred source of working capital requirements. Overdraft, bills discounting, and working capital loan and cash credits are the various forms of working capital finance. Working capital needs of any firm are determined as per the norms. These norms are based on the recommendations of Tandon Committee 1974 and Chore Committee 1979. What is cash credit system? A cash credit facility provides short-term loan to a corporate house. Cash credit is a loan account which helps the corporate to arrange working capital requirements. Cash credit is a flexible lending system which allows the borrower to withdraw the funds as per his requirement. Bank stipulates the cash credit limit for the customer. The customer can withdraw money up to this credit limit. Cash credit account is a running account that is payable on demand with checkbook facility just like current account. Excess of total current assets over total current liabilities is known as net working capital of a firm. Operating cycle of a firm determines its working capital requirement. Operating cycle is a time gap between procurement of raw materials and realization of sales into cash. The requirement of fund depends upon the length of operating cycle. Larger the operating period, larger will be the requirement of funds. Cash credit account supports the smooth functioning of working capital cycle by providing the sufficient funds at the time of need. As per the working capital requirement, bank decides the credit limit of the customer. Features of cash credit systems. Features of cash credit system which makes it highly acceptable by the customers are as follows. Cash credit account is a very flexible account. Borrower can draw upon his cash credit account number of times as and when need arises. There is no stipulation on the number of transactions. Transactions should not cross the drawing limit of the borrower. Borrower can repay frequently in cash credit account when he is having surplus money. Interest is paid on the total amount of credit utilized by the borrower and not on the total credit limit approved. Technically, cash credit is a short-term loan secured by the current asset, such as inventory and receivables. This loan is repayable on demand. But in practice, cash credit acts as a continuous borrowing account which is renewed annually or half-yearly depending upon the performance of the borrower. Drawbacks of cash credit system. Apart from the above desirable features for the borrower, cash credit system has certain drawbacks from the points of view of banks. The drawbacks are as follows. At any particular time, bank has no control over the actual level of cash credit advances. Bank can only control the total amount of cash credit limits. Borrowers decide the actual utilization of these credit limits. Whenever borrower is having surplus cash, he can credit the surplus cash to his cash credit account. This reduces the outstanding balance in the cash credit account and saves the borrower from paying interest cost to the bank and ultimately reducing bank's interest income. The credit limit was fixed on the basis of security available in the account. Sometimes it created the problem of double finance. Most of the times, banks oversell the credit because a major portion of credit limits authorized by banks remained unutilized. The operating mechanism of cash credit system makes a challenging task for the banks to have effective control over the end uses of the credit. If a borrower maintains a certain level of inventory and receivables, then his cash credit account will be fairly active. In this situation, bank cannot demand the customer to repay the loan, and customer uses the credit allowed to him as a permanent source of finance. Cash credit system favors established and big borrowers as they tend to hold big level of inventories, hence their credit limit is also high. This leaves very small room for giving credit to small and new borrowers. Credit limit. Credit limit is the maximum amount that borrower can draw from his cash credit account. If the value of stock is high, even then, borrower is allowed to withdraw only up to his sanctioned credit limit. Security of cash credit account. There are two ways under which securities can be held by the bank. These are: number one, pledge. Under pledge, the position of goods is with the bank. Bank links the drawings in the account with the actual movement of goods from and to the position with the bank. In case borrower fails to pay the borrowed amount, bank can recover the money by selling the goods pledged. Number two, hypothecation. Under hypothecation, goods are in the possession of borrower and bank creates a floating charge on the goods. An agreement binds the borrower to give possession of goods to the bank whenever bank requires the borrower to do so. Borrower has to submit monthly statements of stocks, receivables, etc. Drawings from the cash credit account are based on the stock statements submitted by the borrower. Interest on cash credit account. Interest on cash credit account is charged every month. Interest is charged on the amount withdrawn by the borrower and not on the total credit limit. Borrower transacts many entries of debit and credit every day through cash credit account. Interest calculation is never a problem. Even with many transactions, only day-end balance is charged for interest. Computerization of banks has made this task even much easier. Drawing power. Drawing power is the maximum withdrawal limit up to which a borrower can withdraw from his sanctioned credit limit. Banks used to update drawing power of borrower as it is a very effective post-sanction credit monitoring tool. After sanction of credit limit, drawing power helps the bank to keep an eye on the performance of the borrower. If paid stock shows a constantly decreasing trend over a period, then it is a warning alarm for the bank. Indian Bank Association has come up with the following method of drawing power calculation under the maximum permissible bank finance. In short, MPBF. Particulars and amount. In particulars, you will see total value of stocks, closing balance of stocks, market value or cost price, whichever is lower. Let's term it as A. Less excess of sundry creditors for stocks, B. Excess of other sundry creditors over the level assumed at the time of assessment, C. Now, net value of stock is calculated as D equal to A minus B minus C. Add to this eligible trade debtors including advance payment for stock as envisaged at the time of assessment, let's say this is E, less outstanding under bills discounted, BD. So net value of debtors is F equal to E minus BD. So total eligible current assets are G, which is equal to D plus F, less stipulated margin H. So the advance value is I equal to G minus H. Sanction limit is J and drawing power is I or J, whichever is lower. Stocks are always kept insured. If borrower does not insure, then bank takes the insurance policy. Now let's understand this by taking an example. Example. Let's assume that at the time of arriving at MPBF with stipulated margin of 25%, cash credit limit sanctioned is for rupees 50 crores. Accepted level of sundry creditors of stock is rupees 20 crores. Other sundry creditors are rupees 2.5 crores and advance for stock and expenses are placed at 5 crores. Particulars as per monthly stock statement submitted by the borrower are: value of stock 55 crores, trade debtors 15 crores, advance for stocks 2.5 crores, outstanding under bills discounted rupees 2.5 crore. Sundry creditors of stock is rupees 17.5 crore. Other sundry creditors is 1.5 crore. Now solution. Drawing power calculation under maximum permissible bank finance, MPBF, is like this. First column is particulars and second column is amount in crores. Total value of stocks, closing balance of stocks, their value as per market rates or cost price, whichever is lower, 55, less excess of sundry creditors, nil, excess of other sundry creditors, nil. So the net value of stock is 55. Add eligible trade debtors, rupees 15 crore, and advance for stocks and expenses 2.5 crore. That is 17.5 crore. Now this is within 2.5 crore is within the envisaged amount of rupees 5 crore at the time of assessment. Less outstanding under bills discounted is 2.5 crore. So net value of debtors is 15. Total eligible current assets are 70 crores. Less stipulated margin at 25% is 17.5. Advance value 52.5. Sanction limit 50. So the drawing power is I or J, whichever is lower, that is 50 crores. As amount of creditors in stock statement is lower than the assumed level of creditors at the time of assessment, hence creditors are not deducted. Advance for stock is added as envisaged at the time of assessment. In the above example, although the value of stock arrived at rupees 52.5 crore, but the drawing power will be rupees 50 crore because sanctioned credit limit is rupees 50 crore. Difference between cash credit and bank overdraft. Cash credit and overdraft both are extensively used external source of finance for short-term working capital requirement. Both cash credit and overdraft are repayable on demand. Interest is paid on both the facilities. Apart from these similarities, these two differ in various aspects. Following table helps to understand the difference between cash credit and overdraft facilities. There are three columns in this table: basis, cash credit, overdraft. Account requirement. In order to use cash credit facility, one has to open cash credit account with the bank. Overdraft is an excess withdrawal facility provided by the bank on current account. For availing overdraft facility, one does not need to open a new account. It can be availed on existing current account. Uses. Cash credit is provided specifically for working capital requirements. Overdraft facility can be used for any purpose. Security. For allowing cash credit facility, banks take inventory and debtors as a security. An overdraft facility can be allowed on the security of investments like insurance policies, FDs, or shares. Even credibility of the person can also help to avail overdraft facility. Credit period length. Cash credit facility is usually allowed for a period of 1 year and it is renewed annually. Depending on the individual case, sometimes renewals are done on half-yearly basis also. Overdraft facility is allowed for very short duration of time. For example, 1 month or 15 days or a week. It can also be allowed up to 1 year period. Credit limits. Credit limit is usually a certain percentage of the stocks and receivables. Credit limit depends, in case of overdraft, on the assets kept as security, and even sometimes it is based on the financial statements of the company also. Rate of interest. Rate of interest is lower as compared to interest charged under overdraft facility. Rate of interest is higher as compared to interest charged under cash credit system. Withdrawal limits. Withdrawal limit under cash credit keeps on changing depending on the value of assets kept as a security. Overdraft limit is usually constant as it is based on credibility of the customer. If overdraft facility is secured by an asset, then overdraft limit is based on the value of the underlying asset. Regulation of bank finance, a historical perspective. Commercial banks have always been pioneer in financing working capital requirements of the corporates. Banks used to provide working capital loans after having adequate security. Prominence of holding security by banks used to channelize the flow of credit towards the affluent firms. Ultimately, economic resources were concentrated in highly affluent section of society. Bank credit was easily available to industries, hence they did not use it optimally and efficiently. Small and new entrepreneurs with no tangible security faced difficulties to raise funds for their working capital requirement. After nationalization of banks, demand of bank credit suddenly increased from small sector and priority sector and called for a reform in banking sector policy. The Hazia Committee in 1968 was first to highlight the deficiencies of the existing bank lending system. In 1973, due to record rate of inflation, sudden demand on bank credit increased, and as a consequence, banks freeze the credit limit of borrowers. Tandon Committee. In July 1974, Reserve Bank of India constituted a committee with Shri Prakash Tandon as chairman to frame necessary guidelines on bank credit. Tandon Committee recommended the following notions. 1. Operating plan. Committee recommended that every borrower should draw up an operating plan for the whole year and provide this plan to the bank. This will help the bank to estimate the borrower's credit requirement in the coming year. This will enable bank to perform credit planning process more efficiently. 2. Production-based financing. Banks should make their financing production-based. It simply means that banks should finance only borrower's genuine production needs. Borrowers should try to maintain a reasonably good level of stock and receivables and manage them efficiently. Flabby inventories should be avoided. Flabby inventories consist of raw materials, finished goods, and other stores held due to faulty distribution and poor working capital management. Number 3, partial bank finance. Banks will provide only reasonable part of working capital, and remaining working capital will be arranged by the borrower internally or externally. Number 4, receivable norms. Receivables which are in tune with the firm and industry practices should be financed by the banker. Number 5, information system. There must be an information flow from borrower to the bank. Information flow will serve both operational purpose as well as supervision purpose of follow-up credit. Information should be provided by giving operating statements, quarterly budget, and funds flow statements. Annual projected figures help in genuine credit appraisal, and quarterly figures, when submitted continuously, helps the bank in regular follow-up of the credit. These norms try to bring uniformity among the banks in financing the working capital requirement. Tandon Committee suggested norms for 15 industries. Highly seasonal industries like sugar and heavy industries were not included in it. These norms were applied uniformly to all industrial borrowers, even including small-scale industries. Norms suggested by the Tandon Committee represented the maximum limit of credit, which any bank should not cross in any circumstances. Committee allowed deviations only in circumstances like power cuts, transport delays, and strikes, etc. And these deviations were allowed only for a short period of time. And as soon as the conditions are back to normal, once again, norms should be followed. Lending norms. Committee also recommended the lending norms for banks. According to these norms, firstly, every borrower should maintain a reasonable level of current asset. Secondly, a part of working capital requirement must be financed from long-term funds consisting of owners' fund and term borrowings. Maximum permissible bank finance, or MPBF. Following 3 methods of determining the permissible level of bank borrowings were suggested by the Tandon Committee. First method. Under this first method, bank finances 75% and borrower contributes 25% of working capital gap. Current assets minus current liabilities excluding borrowings from bank is known as working capital gap. This method gives a minimum current ratio of 1:1. Second method. Under this method, borrower should finance 25% of all current assets from own funds and long-term liabilities, and balance is financed by bank. This method ensures a current ratio of 1.33:1. Third method. As per this third method, hardcore current assets must be financed by the borrower. Apart from this, borrower should also provide 25% of the remaining current assets, and remaining working capital gap is financed by the bank. Tandon Committee also suggested that banks should determine new cash credit limit based on quarterly budgeting and reporting system. Committee also recommended that there should be difference in interest rates on loans and cash credit account. Tandon Committee report is landmark in banking. It changed the outlook of both the bankers and the borrowers. Most of the recommendations of Tandon Committee were accepted by Reserve Bank of India except third method. The Chore Committee. To review the system of cash credit, Reserve Bank of India constituted a working group in April 1979 under the chairmanship of Mr. K.B. Chore. The term of reference for the group was to review the existing cash credit system, suggest any modification in the system, provide alternate type of credit facilities which will promote greater credit discipline, and this will relate credit limits to production activities, to make any further recommendations on any other related issue, if group considers relevant to the subject. Cash credit is a flexible lending system which allows the borrower to withdraw the funds as per his requirements. Cash credit account is a running account that is payable on demand with checkbook facility just like current account. Cash credit account is a very flexible account. Borrower can draw upon his cash credit account number of times as and when need arises. Interest is paid on the total amount of credit utilized. Interest on cash credit account is charged every month. This loan is repayable on demand. There are few drawbacks of cash credit system. At any particular time, bank has no control over the actual level of cash credit advances. The credit limit was fixed on the basis of security available in the account. Sometimes it created the problem of double finance. Most of the times, banks oversell the credit. Credit limit is the maximum amount that borrower can draw from his cash credit account. There are two ways under which securities can be held by the bank, that is pledge and hypothecation. Drawing power is the maximum withdrawal limit up to which a borrower can withdraw from his sanctioned credit limit. After sanction of credit limit, drawing power helps the bank to keep an eye on the performance of the borrower. Cash credit and overdraft both are extensively used external source of finance for short-term working capital requirement. Both cash credit and overdraft are repayable on demand. Interest is paid on both the facilities, but still there is a lot of difference between the two. Overdraft is an excess withdrawal facility provided by the bank on current account. After nationalization of banks, demand of bank credit suddenly increased from small sector and private sector and called for a reform in banking sector lending practices. The Hajia Committee in 1968 was first to highlight the deficiencies of the existing bank lending system. After this, in July 1974, Reserve Bank of India constituted a committee with Shri Prakash Tandon as chairman to frame necessary guidelines on bank credit. To review the system of cash credit, Reserve Bank of India constituted a working group in April 1979 under the chairmanship of Mr. K.B. Chore.